What's up, everyone? So today, this is the first video I make, and I'll be going over in this video. I'll give you like a little recap before I start. I'll be going over like what are options trading, what it is, everything you kind of need to know for the day trading, either 0DTE, which is a zero date to expiry. We'll go over that later. And then also swing trading, which you've probably heard about on social media and stuff, pretty popular. This all has to do with options. So this is, kind of goes over that also. Yeah, so I mean, I'll go over like what you kind of need to know, the basics, and then some more advanced stuff, maybe in this video, maybe in a future one, we'll see. So first step to trading options is opening a brokerage. So let me move to my screen here. We can go on the internet here. And brokerages. So this could be anything. This is the one I use, so it's going to be the Webull. It's a good one. This is the one I use, so, pretty popular one. There's also Robinhood in the US. I'm not from the US, so I can't use Robinhood, but that's also a good one for options trading. There's like Questrade and stuff, but we can start with Webull. So what you want to start off with is, let's say, create an account, obviously with your phone number and stuff. It's going to ask you all your stuff. I've obviously done this already, so I won't create a new account. But I always recommend, if you are starting off, to start with a paper trading account. It's going to be beneficial for you and for your bank account, especially. Don't expect to make much money in the first 6 months of trading. I'll be realistic with you. You could get lucky if you do start with a real account, but the odds of that are very low, okay? So paper trading account, that's how I started. Obviously, I was younger, and it wasn't even legal at that time for me to have an account under my name. But yeah, so paper trading account, that's what we start off with. And then, once you've gone through the whole paper trading for a couple months and stuff, then you can move to a cash or margin account. I recommend a cash account. Some people do margin. Really depends. The only difference is, let's say you have $100 in your account. Okay, we'll keep it simple. I'll pull up my little drawing board. Okay, so let's say you have, wow, this is not full screen whatsoever. Okay, we'll just make it bigger. And we can't. Okay, so let's say you have $100, okay? $100 in an account. And your options contract cost you $75, okay? This $75, you cannot use it until you sell the contract, okay? So what happens with a margin account is it lets you buy another $50 contract, okay? It'll let you buy this, but if both of these combined go to less than $100, I hope everyone knows these little math terms. So let's say it will wipe out your balance. So that's kind of the scary part, and exit those contracts automatically. With a cash account, let me erase this. With a cash account, if you have $100 once again, and you buy a $75 contract, wow. If you buy a $75 contract, you cannot buy that $50 contract. It will not let you because you only have $100 worth of cash, okay? So it's like if you take a little loan to the bank, right? With margin, and then this one, it's really what you have. So I always recommend the cash account just so that you don't over leverage yourself and, wipe out the account. So that's going to be the accounts. So we can go over what's kind of complicated with options is that there are the Greeks, okay? So go. Okay, so here are the terms that you need to know in options trading when you do buy a contract. I'll give an example also after. And all of these mean something, okay? So, obviously I wrote these down for it to be easier. I don't know all of these by heart. Honestly, you don't really need to. I honestly don't really look at them that much, but it's always good to know, okay? Especially if you buy options on a stock with low volume and where the spread is, a little complicated. We'll go over that also a little later. But so for your delta, it is the option expected move for a $1 move on the stock itself. So let's say we look at the SPY here. Right now, okay, let's not go on the day, let's go on the hourly, but let's say right now your SPY is at $687.99, okay? Let's say we'll round that up to 688, okay? So it'll be how much the option contract moves on between 688 and 689 or 688 and 687, okay? It'll tell you how much your contract will move, okay? Then you have your gamma, which is the rate of change for every $1 move. So this is how aggressive it'll be on the change. So maybe it'll start off with like a $1 or $2 profit around here. And then over here, by this point, every tick or whatever, it'll be maybe $10. Okay, it's the rate of change, right? So yeah, honestly, I don't really look at these that much. Not that important in my opinion, of course. Then you'll have your theta. This is kind of the more important one you should watch out with. It is the rate at which your option value decreases. So over time, let's say you do a 0DT, right? Because that is the easiest one to look at. We'll go on an even lower time frame. So let's say you buy the contract over here, okay? Let's say you buy it at 10.15, okay? By the end of the day, this contract will close by itself and the value will be $0. Here, $0, okay? So that is the rate of change. It'll tell you that it'll decrease. So if you buy it here and you're buying calls, which is like a long, if you're looking at a Forex or whatever, a call is betting on the price going up and puts are betting on the price going down. Okay, so if you buy it at where I put my line here, right here, and you sell it at the, it's a little harder to explain here, but let's say you buy here and sell it around here, okay? This move, the value of the contract will not decrease that much just because of how short it was, right? But if you, I don't know, buy it here and sell it towards the end of the day, the value of the contract will be less. So let's say this would have been maybe a 90% move. This here would be maybe 50 because obviously it's less, but not that much less. Just because over time the value of the contract will decrease. Okay. I mean, those are kind of the basics. Usually 0DT, you don't hold those more than maybe an hour or two, at least in my opinion. Then I would suggest if you're holding it longer than that, you go, with further away contracts. Yeah. So a book recommendation to kind of understand what is happening with options is Options Trading for Dummies by Joe Duarte. I can pull it up on here. So. Here, this one. Oh, not videos. Yeah, this is a good book to start off with. Oh, you don't even see it. My cam. So this one, very good book to start off with. kind of explains pretty much what I'm going over, but obviously more in depth. I highly recommend you obviously do a little more research in this little video, but kind of an intro to what they are. And we can also look at the options itself on the chain of options. Obviously, I will open my Webull account for this. So we'll keep it with SPY also. So this is going to be your options chain, okay? So these are the options chain. Your price in green, this is what the current price of the stock is at. If you buy puts, you look at the contracts below. Oh, my grandmother just texted me. You look at the contracts below. Usually you try to stay in between the first couple here. The move will be more aggressive on these. And then if you're looking at calls, obviously you look at the couple at the top, right? And then you'll have all your information, like what we just went over, the delta, gamma, theta, all that stuff. It will be on the contract directly. And then the prices, okay? So how it works, I go back to my little drawing board. How it works is that, here we can move this. How it works is, let's say a contract is at 1.00. This means that the value of the contract is $100, okay? Because it's always 100 times the value of it, right? The move or how much you're spending for it and so on. So let's say it moves to the contract value to 1.25, right? This would have been a 25% move, right? Your contract value will go to $125. Pretty simple. Now on stocks like maybe Tesla, okay? Your contract value will be more expensive in general than maybe your SPY, IWM, or QQQ. This is because there are more people that sell options on indexes than on actual stock. This is why that if you're looking for cheaper contract values, which is mostly what I do because I do have a smaller portfolio that doesn't let me spend maybe $1,000 per contract. I don't want to have 1 or 2 contracts only. You know, ideally I want to aim between 5 to 10, okay? So this is why if you're trading maybe lower prices stock, like here, DJT is a good one, right? These options are very cheap, right? First of all, the price of the stock is at $14. So you can find options at 15 cents. Well, obviously the value of it, like I said, the option contract, if it's at 0.15, this equals to $15, okay? So this lets you buy more contracts, which is better than holding maybe one expensive one or 2 expensive ones. Then you don't have as much leeway on when you want to sell it, okay? For your take profits and stuff. Yeah, so that's kind of a little overview on what options are. So if you're trading, I'm gonna kind of change the topic a bit, but if we're trading on paper trading, the value of your option will move in your favor more than if you're trading on a real account. So always keep that in mind if you're trading on a paper account, and also obviously you don't have fees and stuff. Let's say on Webull, it's $1 per contract that you'll pay in fees. But for paper trading, obviously no fees, and also it is kind of put in your advantage. So when you buy a contract, let's say at market value, usually you'll be maybe a couple dollars less than what it actually is, just because obviously the brokerage wants to take a little cut of your money, and they need to make their part. But on paper trading account, if you buy a contract, let's say this is the market, okay? Let's say you buy your contract right here, okay? On a paper trading account, it will actually enter at this point. If you buy on a real account, and you enter here, the value of the contract might actually be over here. Just because this little change in price, the brokerage already took that little commission out of it, right? And same thing when you're selling. Let's say, you know, it goes up to your price. This is your take profit. Obviously, if you do limit sells and market sells, go over that also after. But let's say you sell at your take profit, right? On a paper trading account, it will sell at the highest price or the current price that it is. If you're trading on a real account, it might go a little below at your market sell, just because obviously now the brokerage took another little commission or, you know, a little spread on your contract. Yeah, we can go over market and limit sells. So for a market sell, that just means it'll try to sell it as fast as possible at the market price. As I said, on a real account, it will be maybe a little less than what you actually see. Let's say you see 40% in the green. Okay, for example, it might actually sell at 37% or 38%. Okay, just so that's kind of what they do, right? That, I mean, you can't get away from that. But on a paper trading account, it will be at the actual 40% mark. Yeah, so for a limit sell, this is where you decide the price at which it will sell at. So let's say you buy your contract here, and we'll connect this together. Okay, let's say you buy your contract here. Okay, it was at 1.00. You sell at your highs. You sell it at 1.40. This is your 1.40. If you do a market sell, it might sell it at 1.38, maybe, okay, a little lower. But if you really want to sell it at your 1.40 and get your full money's worth, let's say, you just go in the limit sell and you put in that price. You say, I want to sell it only at 1.40. The only problem with this is that on a real account, for it to sell at 1.40, it might need to be a little higher, you know? So yeah, so price might need to be here for your contract to sell at 1.40, just because again, they take a little profit of the money you tried to make, right? So that's what market and limit sells are. Okay, and now we can talk about the market buys and limit buys. So it's same type of thing. Let's say this is the move, right? And we'll do puts for this one, okay? So over here, you want to buy, right? It's breaking a level or whatever, and you want to buy. You think it's going to go lower. So what you do, you either obviously look at the contracts, which one you want to buy, and let's say there's a contract at 1.00. Okay, right here at this price. So, and you want to buy this. What you can do, if you think, let's say price moved a little further, if you think it's going to retest at the price, you can say, okay, I'm going to buy it at 1.00. So you put a limit buy at 1.00 and wait for it to go back to your price. Or if it's a little lower and you don't think it's going to retest and you really want to buy it here, obviously then we forget about this thing, and you really want to buy it here, then the contract might be at 1.005, and then that's where you do a market buy, right? You don't care when exactly it entered, you just want to enter. So you do market buy at this value. It might actually fill at this price, okay? So then let's say it goes down, it goes down, it goes down, and you want to sell now, okay? So like we explained, you do either the market or limit. That's really up to you to decide. What I recommend, if it's moving very aggressively, I usually do market sells just to be sure I sell, especially if, let's say, I'm up a couple 100% maybe, and it's moving very fast and I don't want to miss the sell opportunity. I'm going to just do market sell. If it's a runner, that means a contract. Okay, here, actually, that's a pretty good term to have. Runner. So this usually equals 2. The last maybe 2 out of 10 contracts that you're still holding. So this will be your last couple contracts that you're holding to try to squeeze out the most profit possible, right? So these, your runners, usually I'll sell on market buy or market sell, sorry, to just make sure I lock in those profits. You can also have predetermined sell points and then put them in before. So that would be a limit sell. You can say, if I buy it at $1 the contract, I want to sell it at 1.5, right? $1.50. So then you put your limit sell at $1.50 and just wait for it to hit. Okay, you can do that. I've personally never really done that, but yeah, to each their own. Yeah, and I think that goes over kind of limit buys, limit sells, market buys, market sells. Yeah, so honestly, it's probably the same thing in the forex, the longs, and the shorts. I only do that with, let's say, crypto if I trade leverage crypto, but it's pretty similar, right? For options, also, what I recommend, let's say we can go a little lower, a stop loss. So I hope people that are watching this know what a stop loss is. So stop loss. So this is, let's say, you're anticipating this to go a little higher, right? You want to sell over here, you're buying here, but it doesn't do what you want, and it goes kind of like this, right? And you want to sell it at this support. So what you do, you either put in a stop loss directly in when you buy it. You either say, I don't want to lose more than $40 on this contract, so then you put in your stop loss. That's fine. You can do that with options also. But then again, if you're trading on a cash account or margin account or just a live account with real money, what it'll do, let's say you put your stop loss here, it might actually sell your contract a little higher just because the brokerage will take another share of your money, right? So I personally don't use stop losses. What I do is, if I see that the price is not going in my direction, I might sell half of the contracts here, another portion here. And then if it goes really low, I'll hold a couple, and then I'll be like, okay, this move is done, let them go, right? I'll just do market sells for those. It's like, and also in options, what I recommend, let's say you have $1,000 in your account, okay? This is your account balance. You have $1,000. I recommend that you keep your, let's say you do one trade a day, okay? I recommend that trade is between $50 to $100 maximum. Especially when you're trading a lower amount like this. Don't go over this. Don't spend more than 5 or 10% of your port on a contract, just because I've personally been through this, that it moves up a bit and then instantly goes down, and your contract is worth $0 now. And obviously that's not fun, but it can happen. So especially with 0DTE, where it's extremely high risk, always put less on the table, right? Whatever you put on the table can be taken away as fast as you can make some money with, right? So keep that in mind. If you go in heavier than this, and it let's say it goes up, we'll keep this example here on the side. If it goes up in your price and goes back down, I just sell at about where I entered most of my position, and then hold what I would be more comfortable in actually losing, okay? So never enter a move with money that you're not okay to lose. That's my recommendations. I've done the mistake in going in too heavy and then losing half my port. That's obviously happened. I haven't lost the full port because I haven't entered with the full port on one move. But yeah, you can lose the contract value pretty fast, faster than making 100%. That's for sure, especially on a live account. So yeah, and also what's good with options, which you won't have with, okay, so we don't have much more place than this, huh? Well, okay. Yeah, so what's good with options compared to maybe, forget this, okay? Forget this. What's good with options is that if you buy a contract at 1.00 and it goes to 0.00, that's it. You lose your $100. That's minus $100, right? With, let's say, long positions, right, like Forex and stuff, if it goes even lower than losing that amount of money, it'll start taking it off of your actual account. So what's good with options is that when the value of the contract is at 0, it'll sell it at 0. You can't lose more than the value of the contract. So that's good. This is why that you always enter knowing in your brain that if you lose this 100%, you need to be okay with it. Okay? Never enter with money. Never put money on the table you're not okay to lose. Never. Okay? That's a big rule. Big rule in trading. Anything. This rule goes across the board. But with options, it's a little easier to gauge that just because it won't go lower than the value of the contract. Like you can't lose more than that. Obviously, maybe some fees and stuff like that, but you won't lose more than your $100 in this one, for example. So yeah, that's a pretty good little introduction to kind of what options are. I think that'll be it for this video. In the next one, I'll put a couple more out on like the little strategy I use, and go over maybe like support and resistance, trends, and stuff like that. How to set up your trading view, what indicators I use, and stuff like that. And options also, I'm going to do one last point on this. Options works with pretty much every stock. Almost every single stock will have options for it. Now, sometimes they won't have lower time frame options like 0 date to expiry, 0 DTE. That you might only have those on big indexes, right? Now, obviously, I haven't gone through all the stocks in that's ever been existed, but in general, you do have options pretty much in every single one of them, right? It's a pretty common thing. Most hedge funds will use options. Let's say they buy $1 million of a stock. Okay, so $1 million of a stock. And they are expecting the stock to go up, right? What they'll do is they'll buy maybe $10,000 worth of put options. This is to hedge. So if ever they enter, let's say the stock's doing this, and they enter here, okay? They're expecting it to go a little higher. If ever the stock kind of goes a little lower, well, they'll make money on the puts. At least they'll make money on the puts. If it goes higher, then obviously then they just make more money because they actually bought the stock. But dollars worth, I should say, of puts. But yeah, so let's say big hedge funds, obviously these numbers are going to be much higher, but let's say they buy $1 million worth of a stock. They'll also buy $10,000 worth of puts. so that if it does go down, at least they make a good amount of money because, you know, this is 100x leverage. Technically options are puts on it. So if it does go down, at least they make money with puts, right? That's called a hedge. So you're hedging against your own position. Retail traders do this, obviously with lower amounts, but mostly institutionals and big banks and hedge funds and all these big players, that's what they'll do on a huge position. So that it's like a little safety net. If ever the price does go down, at least they're still making money, right? They're still making money. So that's what big institutionals will use options for in general. Now the retail trader like myself and probably you, we're going to use options as the vehicle of investment, right? So it's a completely different way to look at it. Yeah, so we're using options as the vehicle and not as a hedge, right? So I think that kind of goes over what options are, what it is, and yeah, I think that'll be it for today. I'll put like a little story of myself and kind of get to know me a little more. But yeah, and I'll go over strategy and stuff in future videos. But for a little introduction, I think this is pretty good. The book I recommended, I can pull it up again. This is pretty good for people starting off. You have no clue the fuck I'm talking about right now. This is pretty good. This will give you a little introduction. Well, a little introduction. It's the book, right? So might take you a couple weeks, but you know, I always recommend. Books are the true education. You can buy all the courses. The course seller's information, most of the time, comes from either personal experience and knowledge from books and yeah, from books. So where else are you going to get the information, right? And online, obviously, but you know, yeah. And then we'll also do like a psychology and everything, because once you have your strategy in place, once you know what you're doing, then the hard part comes. Then the hard part starts with knowing when to take profit, when to cut your losses, not over trading, and yeah, a bunch of stuff to go over. So that'll be it for this first video. I'll be posting more soon, so you know, like, subscribe. Helps with the algorithm. Comment if you want. I'll try to answer. Well, there probably won't be that many people, but you know, I'll answer all the comments down below. Also, I do trade live on Kick when I can, if I don't have school in the morning. If I do, then I won't. Also on my TikTok, I'll link all of that in the description down below. Yeah, and I also have a Discord that's going to be starting soon. Here, we can open that up if you want. So yeah, so this is kind of the Discord I'll be starting up. These are kind of the callouts I've started doing last week. You can look at them if you want. You have the dates and what I was entering. And yeah, I'll go over this, how all of this works and everything in a future video. So for a first little introduction, I think this was good. I'll see you in the next one. Ciao.